The morning of December 15th, 2025, began not with a bang, but with a quiet, cascading wave of red. Across the world, traders arrived at their desks to a scene of digital carnage. Screens that had glowed with the steady green of a decade-long bull market were now bathed in an unnerving crimson. The Nasdaq, the engine of technological optimism, was in a freefall, shedding points with a speed that felt personal and vicious. Bitcoin plunged below the psychological barrier of $90,000. It was a brutal, indiscriminate sell-off, a sudden storm that appeared from a clear blue sky. Amidst the chaos, one asset moved in the opposite direction, a lone beacon in the storm. Gold surged to a record high of $4,323 an ounce. On trading floors, New York, London, Hong Kong, the familiar hum of commerce was replaced by a tense silence, broken only by the frantic ringing of phones and the strained voices of brokers trying to find buyers where there were none. The feeling was palpable. Something fundamental had just broken. It was a day that defied the logic cultivated over the last 15 years. The strategies that had produced consistent, almost effortless returns suddenly failed. Buying the dip became a fool's errand, as each dip was followed by an even deeper one. In hours, the market sent a single terrifying message. The rules of safety you learned for the last decade just expired. The first chapter of this story is about the engine that powered the market for half a decade: artificial intelligence. The narrative was simple and intoxicating. Companies would invest billions in building vast AI infrastructures, data centers, specialized chips, complex software. In the future, this infrastructure would unlock unprecedented efficiency, create new revenue streams, leading to explosive profit growth. Investors, mesmerized by this promise, poured trillions into any company linked to the AI gold rush. Valuations weren't based on current earnings, but on the projected earnings of a distant, AI-powered utopia. Then, the reality check arrived. Cautious language buried in earnings reports. Broadcom, a critical supplier for AI, warned that while AI revenue remained strong, margin pressure was rising. The immense cost of research, development, and manufacturing was beginning to eat into profitability. Shortly after, Oracle announced delays to large-scale data center projects, citing supply chain complexity and sheer cost. The delay sent a ripple of concern through the market. It suggested a different reality: bottlenecks, soaring costs, and timelines stretching further into the future. The AI bubble didn't burst because the tech failed, but because profits were too far in the future. The market is a discounting mechanism. When future value is pushed further away, its present value collapses. The faith in immediate world-changing profits evaporated, and with it, the justification for sky-high prices. It was not a judgment on the technology, which remains revolutionary. It was a re-evaluation of the business of technology. Promises are easy to make, but difficult and expensive to keep. When timelines extended on December 15th, the edifice of valuations began to shudder and crack. A violent repricing swept across global markets. The AI reality check weakened the story and set the stage for the next shock. The calm surface had hidden powerful currents beneath. The butterfly was about to flap its wings in Tokyo. The second chapter is about liquidity, the lifeblood of the market. For over a decade, the yen carry trade made that blood flow freely, an overlooked mechanism acting like a global ATM. With near-zero rates in Japan, it was incredibly cheap for banks and hedge funds to borrow yen. They borrowed yen and bought US stocks, emerging market bonds, pushing prices higher and injecting liquidity. Think of it as a steady wind at the market's backs. Cheap money from Japan helped inflate assets from tech to prime real estate. Facing domestic pressures, the BOJ signaled a historic shift. Whispers of a hike grew louder. December 19th, widely expected as the first rate increase in a generation. Not a tweak, the signal that the global ATM was about to be unplugged. The cheap money spigot was turning off. Expectation alone triggered a massive unwinding. If yen borrowing isn't nearly free, the carry trade's logic reverses. Borrowers must pay back yen. To do so, they sell the assets they bought. US stocks, corporate bonds, real estate funds, fast. A sudden, immense selling pressure hit markets everywhere at once. Algorithms kicked in, sell assets, buy yen. With ruthless efficiency, bids vanished, air pockets formed, prices plunged on little volume, a classic liquidity crunch. A subtle shift in Tokyo became a tidal wave in New York. It revealed a system tightly interconnected and dependent on cheap credit. The AI reality check weakened the narrative. The carry unwind knocked it over, draining cash and turning a correction into full-blown panic. In times of extreme stress, investors flee to safety, the flight to quality. On Black Monday, their journey revealed a divergence between two so-called havens: gold, the ancient store; Bitcoin, the purported digital gold. One behaved as a shelter from the storm, the other was swept away by it. Gold, the ultimate analog asset, performed its historical role with textbook precision. Stocks plunged, crypto plunged, gold soared, hitting a record $4,355 per ounce. Its strength lies in simplicity. Gold's value doesn't depend on a company's earnings, a government's creditworthiness, or a complex technological network. It has no counterparty risk. You don't need someone else's promise for your gold to be valuable, exactly what terrified investors craved. Proponents argued decentralization and fixed supply made Bitcoin a hedge. Yet as the crunch intensified, Bitcoin didn't act like a haven. It behaved like a high-risk tech stock. It crashed below 90,000, tumbling to as low as 85,600. Investors raising cash and meeting margin calls sold what they could sell quickly. Bitcoin, among the most liquid. Despite its philosophy, Bitcoin had become integrated into the financial system, held by hedge funds and large investors unwinding yen trades. For them, it was another asset on a spreadsheet, a liquidity source to tap in a crisis. Instead of hedging systemic risk, it became a victim of it. The divergence wasn't about which asset is better, it was about behavior under severe financial pressure. Section 8. Conclusion. The new 2026 Playbook. The aftershocks of Black Monday leave us with the essential question: what happens now? The events of December 15th shattered the old playbook, forcing investors, policymakers, individuals. The path forward isn't a single road. 3 primary scenarios loom for 2026. Each carries risks and opportunities. Scenario 1. A sustained liquidity crunch. If the Bank of Japan continues its tightening cycle and other central banks follow suit, the global supply of money will remain tight. Credit gets more expensive and harder to obtain. Companies reliant on cheap debt struggle. More bankruptcies, slower activity. Markets face further selling pressure. Valuations compress in a world with less cash. Risk assets sag. Cash and short-term high-quality debt are king. Scenario 2. A swift Fed pivot. To counter pain and recession risk, the Fed could cut rates and restart liquidity programs. That likely triggers a powerful rebound, but at the cost of reigniting inflation and eroding credibility, inviting policy volatility. Scenario 3. A sovereign debt shock. Slowing growth and higher rates pressure indebted governments. A country struggles to roll over its debt, sparking a confidence crisis in bonds. A chaotic scramble for safety could drive gold higher and royal currency and bond markets. Even the notion of risk-free gets questioned.